How do you know when it might be time to change financial advisors? Stick around, let's find out. Hello and welcome to another video from One Up Financial. I am your host, Eric Persogna, here to help you increase income, reduce taxes, and invest smarter in retirement. I meet with prospective investors on a weekly basis, and rarely do I hear complaints of poor performance or a lack of service from their advisor, especially considering we are in the late stages of a bull market that continues to push 401ks and IRAs higher and higher. But as the saying goes, the devil is in the details. It usually isn't until after several hours meeting with a prospective investor and reviewing their financial statements, investment statements, and tax returns that I begin to uncover areas of opportunity that they didn't even know existed. The financial services industry has changed drastically over the years. The emergence of technology has resulted in fee compression, which has forced some advisors to either reduce their fees or enhance the level of services that they're offering. Believe it or not, there are a number of advisors who have yet to adapt to this ever-changing environment and continue to push expensive products, overcharge for their services, and underserve their clients. The sad part is most people who work with an advisor like this have no idea if they're being charged too much or if they're missing out on a valuable service. They simply don't know what they don't know and rely heavily on trust. Now, don't get me wrong, trust is essential in every relationship, and financial services and professional services is no exception. But where I see the problem is when that trust is abused. And unfortunately, over the past 20 years working in the advisory world, working as a CPA, I've encountered too many instances of this throughout my career. And that's the basis for this video, really, is to protect investors from being charged too much for too little. Here are the 5 warning signs that it might be time to start shopping for a new advisor. Number 1, excessive fees. Now, the average fee in the market for financial advice, that is advice charged by a fiduciary who always acts in your best interest, is right around 1% of assets under management. So to give an example, if you have a $3 million portfolio, that equates to roughly $30,000 a year in fees. Now, is that excessive? Maybe, maybe not. I think it really all depends on the value that you're receiving for those fees. Quick example, quick story. I met with a prospective client a few years back, and he kind of had money all over the place. I was reviewing his tax return and noticed that he had some funds at a local brokerage firm. His money was invested in an actively managed mutual fund that was charging about 1.5%. So the expense ratio on that fund was 1.5%. In addition to that, I noticed that the fund had really underperformed over the past 5 years, and this person's account balance pretty much remained the same for the past 5 to 6 years. On top of that, this individual didn't even know who his contact was over at the brokerage firm, so he really hadn't been met with in years. To top it all off, I saw that on his tax return, he had $20,000 in capital gain distributions coming from that mutual fund. So if you take into account the taxes and the management fee, this individual was paying nearly 2% in management fees. Now, that's not excessive. That's basically like stealing money. I mean, I don't know what else to say other than that is just egregious. It is so important to know what you're paying in management fees. And that's not just the management fees that you're paying to your advisor, but also what the funds are charging that your advisor may be using in your portfolio. Second warning sign, what I refer to as portfolio dormancy. So think about the last time that you looked at your investment statement in the mail or on your email. More than likely, you glanced at it briefly, you made sure that your account balance was going up, and then you tossed it. And honestly, I don't blame you, because sometimes those things can be very confusing and often too long and too cumbersome to kind of go through. But the next time that you open your investment statement, or better yet, when you're meeting with your advisor, look for trading activity. Look for any kind of buys or sells that are going on in your account. And the reason for that is some of the larger institutions and brokerage firms tend to spend more time and resources on the larger, more profitable accounts than they do some of the smaller ones. And by definition, sometimes they refer to smaller accounts as anything less than $3 million. This can result in what I refer to as portfolio dormancy, or pretty much just a lack of attention being paid to your account. Rebalancing, tax loss harvesting, adjusting your investments for risk tolerance or whatever else is going on in the market. Sometimes these things are not being done as consistently as they should be, and that obviously can hinder your performance and your long-term success in retirement. Now, that doesn't mean that more trading equals more service or better results. In fact, too much trading can actually be detrimental to long-term performance. I'm not saying that you just look for a ton of trading activity and everything is fine. All I am saying is it is very important to be cognizant of what your advisor is doing for you, and make sure they're paying as much attention to your account as they would a $5 to $10 million account. Because this is your money, you've saved your entire life for it. You deserve to have the full time and attention of your advisor, and make sure that they are actively managing it and rebalancing and looking for opportunities to tax loss harvest, all of which will result in trading activity that you can easily monitor when you're looking at your investment statement. Be sure that you're getting the attention you and your portfolio deserve. Number 3, lack of a financial plan. I honestly don't know how it's possible to have an investment strategy without a financial plan. That's like going on a long road trip with your family without taking a map or a GPS. It just doesn't make any sense to me. Your investments are merely one piece of a much larger financial puzzle. Questions like, when should I retire? Or do I have enough? Or what is my number? Am I spending too much? Am I saving too little? Should I be taking more risk in the stock market or less risk? Am I paying too much in taxes, or what am I paying in taxes? All of these questions are so critical in creating a comprehensive financial plan that will in turn drive your investment strategy going forward. And when I start to ask prospective clients some of these questions and I just get this blank stare, it's evident to me that they don't have any kind of financial plan in place whatsoever. Having a clearly defined financial plan that you understand and that your advisor reviews with you and updates on an ongoing basis is critical, and it will help drive your investment strategy. You can't have one without the other. 4th warning sign: decline in meetings and phone calls. Getting back to my earlier example of the individual who was paying 2% in management fees for absolutely nothing, be cognizant of how often your advisor meets with you or calls you. Usually in the beginning, an advisor will spend a lot of time with you. They will treat you to dinner, they'll treat you to lunch, client appreciation events, a wine tasting. This is a common way for advisors to win your business and then nurture that relationship. But over time, that attention may start to fade as complacency sets in on the advisor's part, and what was once 3 to 4 in-person meetings, maybe a dinner and a client appreciation event, now turns into a phone call here and there, maybe something in the mail, and a birthday card. Financial advice is a service-based business, and service is exactly what you should be getting, especially if you're paying tens of thousands of dollars each year to your advisor. Last, but certainly not least, number 5, 5th warning sign, is a larger than expected tax bill. This was about a year or so ago. I was sitting down with a prospective client and reviewing their tax return, and this individual was surprised that his tax bill for the current year had increased substantially than the prior year. Actually, last year I believe he even received a refund, and this year he owed money. So after further review of his tax return, I noticed that he had started taking required minimum distributions, or RMDs, from his IRA. In addition, he was also receiving Social Security benefits, so if you combine those two, it actually pushed him up a little bit in tax brackets. But that really wasn't what caused the increase in the tax bill. What caused it was a $40,000 capital gain distribution from the mutual funds that were in his brokerage account. So when I reviewed it with him and I looked at the statement, I said, well, why are these in here? These are high turnover, actively managed mutual funds that are kicking out capital gain distributions. And when I say distributions, I don't mean he received $40,000. I just mean that the mutual fund required him to report $40,000 in long-term gains on his tax return. So in this case, clearly the advisor just neglected to look at the turnover in this mutual fund and place it in a taxable account that caused this individual to pay, I think roughly, it was about $6,000 additional in taxes that year. It isn't enough just to be adept at picking funds or stocks or bonds or ETFs. Wealth management is about so much more than just managing portfolios. Be sure that your advisor is competent, credentialed, and knows his or her way around the tax code, or else be prepared for an unexpected surprise come tax time. These warning signs might not always be easy to spot at first glance. If after reviewing your financial advisor relationship, you start to notice some or all of the things that I discussed in this video, please feel free to give me a call or shoot me an email for a second opinion. Thanks as always for tuning in to watch our videos. If you're interested in keeping up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks as always, and we'll see you in the next one.